You're probably thinking, okay, we got a good jobs report, so why would the markets react negatively to this? Well, let me explain why. If you go over through here, here's where the 10-year treasury is. I'll start with this. The 10-year treasury yields shoot higher above 4.53 after a strong jobs report. Let me explain why. 4.5, that was the trigger point we were watching for. So this isn't good news. That's kind of a barrier. Once we pass that, then it might be up, and away from there. But let me go over and explain to you guys what's going on. So here's what the Federal Reserve looks at. Here's basically what the markets look at to figure out where inflation's going, and then thus where they can figure in and tag interest rates. Okay, I'll explain it this way. Federal Reserve, they monitor that rate over there. It's called the federal funds rate. All it is interbank lending. It doesn't control your mortgage rate. It doesn't control your car loan or your credit cards. Now, once they adjust this, the markets usually adjust. But then the Federal Reserve monitors two main things. They monitor inflation, the PCE. Well, we know that's high. We're going to get a lot of inflation numbers next week. I'll give you my thoughts on that. We're going to give a recast of what's coming, or a look ahead of what's coming down the pike next week. But then they look at the jobs numbers. So here's what the Fed's looking at. They're like, okay, inflation's high. We know it's high because of oil. But let's get over to this jobs report. Let me show you the good news behind this. And again, if the Federal Reserve's looking at this saying, okay, the jobs market's good, meaning people were working, people were making more money than they were, and they're keeping up with inflation, and it looks like they're still spending, do we need to cut rates? So that's what's happening.